What do rising treasury yields, Canadian mortgage rates, and Trump's tariffs all have in common? It's part of a complex chain reaction that's reshaping the mortgage market right now. In today's episode, I talked to probably one of the smartest mortgage brokers I know, or certainly one of the mortgage brokers who's the best at communicating this stuff in natural language that people like me can understand. I love having Dave on the podcast a few times a year, and I know you're going to love this conversation. We talk about inflation, forecasts, fixed versus variable strategy. We talk about how he brings clarity to the chaos, and also how some ideas he has for improving the housing supply, which is actually pretty creative. I hadn't heard of before. I think you're going to really enjoy this conversation. Hey, I'm Scott Peckford, founder of Bricks Mortgage. As a brokerage, I started 4 years ago, and we've already surpassed over $4 billion in mortgages. You can check us out at whybricks.com. And in this episode, you're going to really enjoy this conversation I have with Dave. Before I do that, I want to give a shout out to our sponsor, Omwell. Omwell is a tool for Canadian mortgage brokers to send these amazing reports to their database or past clients, and it shows their buying power and their home equity on a monthly basis. And they get open rates of 60 to 80% because it's specific to the borrower. Very powerful. And they create tons of conversations around what should I do? Can I refi? Can I buy? And you can check them out at omwell.ca/Scott and check out this conversation with Dave. Hey, Dave, welcome to the show.
Hey, Scott. Good to be back.
So I always love our conversations, and I jokingly say that when I talk to you, my IQ goes up temporarily, and then it drops down very quickly afterwards because I can't remember exactly what you said. But so maybe for anybody listening that doesn't know who you are, you come on periodically. Who are you, and how long have you been in the mortgage biz?
So I'm a Toronto-based mortgage broker. I've been in the business now 25 years. So I guess this is what I'm going to be when I grow up. I did my MBA, graduated in 2000. My first 10 years, maybe not quite 10, were spent in lending, and finished. My last lending job was VP Sales and Marketing for Exceed Mortgage, which is now NCAN. Became a broker after the financial crisis in 2008. Wanted to hang out my own shingle and give it a go. And we're 16 years later. So, like I said, guess this is what I'm going to be when I grow up.
Perfect time to become a broker right after the financial crisis. It's like, hey, everybody's heading for the door, and you're like, this seems like a great career path. I mean, it's worked out for you, but it definitely was a challenging time.
Some people thought I was a bit nuts when I did it, to leave the salaried world for 100% commission, but I always wanted to be independent, and we got to bet on ourselves, right? That's what people who are successful in anything do. And yeah, looking back, it started with a desk and a phone. Went from a very generous expense account to an office with no art on the walls and just a desk and a phone, and that was.
And then, but your blog has been instrumental in, I feel like, in helping you build your brand as well as clarify your thinking, because you get a lot of clients, a lot of traffic. I tell everybody to go check out your blog, whether they're in the industry or not. You do a great job of simplifying things, helping people understand the micro and macroeconomic factors that are going on. And so I will put a link to your blog as well, which we always do in the show notes. But so maybe talk to me now about like what's going on with rates. Let's talk about should we start with inflation or fixed or variable? Where's the logical beginning point, do you feel like, for our discussion today?
I mean, we can take it in any direction you want. I mean, if we're talking about fixed rates right now, it's really a U.S. story. Our fixed rates, of course, are priced on Government of Canada bond yields, and Government of Canada bond yields follow the path of U.S. Treasury yields. And U.S. Treasury yields right now have headed higher, and I think they've got a floor under them. And right now, I think U.S. Treasury yields have an upward bias, and relatedly, I think Canadian fixed mortgage rates have an upward bias for several reasons. U.S. President Trump has announced all kinds of tariffs, and it's a bit of a bouncing ball. But the belief is that tariffs will raise prices and be inflationary. We're not seeing that in the data yet, but we will soon, and I'll get to that in a moment. But he's also enacted his big, beautiful spending bill, or budget bill, and in that there were tax cuts.
Is he the only guy who came up with his own name for that? I mean, most people just call it the budget. It's like his big, beautiful. He's got to put some, anyways.
Yeah, that's Trump.
Carry on.
That's Trump for you.
Yeah, that's Trump.
It's got to be covered in gold and tacky. Anyway, when he launched that bill, it meant that the U.S. federal government's deficit would be the widest it's been since World War II. And of course, after World War II, there were lots of reasons to run a deficit. You had soldiers coming home. You had to rebuild the economy after turning the U.S. economy into a war machine to win the war. But now the U.S. is not even in recession, and their deficit spending is equal to what they would normally be spending in a very severe recession like the financial crisis in 2008. So the bond market is looking at that saying, well, U.S. deficit spending is out of control. We haven't gotten back to the 2% target. We're not even flirting with it at this point. And we haven't yet seen the effect of tariffs. And even though the market now thinks the Fed will cut at its next meeting on September 17th, normally longer-term U.S. Treasury yields would go down if the market thought the Fed was going to cut for the same reasons that the Fed would be cutting, that the economy was slowing and that the same slowness that was catching the Fed's eye would cause the economy to slow and ease inflationary pressures to a point where investors would demand less return on their treasury yields because they'd be less worried about inflation eroding those returns. But even though the market thinks there's an almost certainty the Fed will cut now on September 17th, longer-term yields are going up. That's very unusual. So what the market is saying is we think the Fed's going to cut, but we also think that inflation is going to be a problem ongoing, and we want more compensation for that. For longer-term outlays when we buy U.S. Treasuries with longer terms, because we think inflation is going to erode more of our return. Here's what's interesting: the latest U.S. inflation data came out. It was as expected. It was 2.7% year-over-year inflation increase, and the market reacted to that positively. Equity markets went up, and basically it was seen as a positive report because inflation didn't move higher. But here's the concern. Right now, the main driver of U.S. inflation is service costs, and tariffs don't affect service costs. They affect
What do you mean by service costs?
So the price you pay for haircuts or taking airline flights or something involved in a service as opposed to a good. Okay, so goods obviously,
right.
Food, computers, PlayStations, clothing, things like that. The tariffs don't affect service prices; they affect goods prices. And right now, the inflation we're getting is coming from service costs and service prices, but everybody expects goods prices to start increasing soon because of these tariffs. Because for a while, when the tariffs were announced, they weren't implemented right away. Companies bought a ton of inventory to basically get as much in the door as they could. They've been burning through that inventory, which they purchased pre-tariff, so they were able to keep prices stable. Then companies said, well, Trump always changes his mind, so let's take a hit to profit over the short term and not increase prices because we're concerned.
Maybe he's going to change his mind and everything goes back to normal.
Right.
Yeah.
And consumers now don't have the kind of household savings they did when COVID ended. And yes, back then, the last time prices went higher, consumers paid the higher prices because they could. They had COVID savings. There was pandemic stimulus given to them, and they spent less during COVID. But that's not the case anymore. Households are strapped now. So businesses are afraid to raise prices now. What caught the eye of the smart folks who I follow, and I wrote about this in my blog last week, is the producer price index, which is the wholesale price index. So we have the consumer price index, the CPI, which measures consumer prices. The wholesale index measures what businesses are paying for what they buy. That spiked to 0.9% growth month over month. And the market expected it would be 0.3. So it was triple what the market was expecting. And what that means is businesses are now paying a lot more for the goods that they buy. And it won't be long before those
prices are going to go up. Is what you're saying is this is all leading indicators. If there was a thing on the dashboard of your car, a light, this is saying prices are going to go up on goods.
Goods prices are going to move higher. Right now, U.S. inflation is above target and being driven by service price inflation. Goods prices have not increased by much. If goods prices are about to increase, which is indicated by the latest producer price index result, then there's going to be a second leg pushing U.S. inflation higher. So government spending is rampant. Service inflation is already high. Goods price inflation, now the indicators are that it's coming through the pipeline. All of this says the U.S. is going to have more inflation. The bond market has taken notice, and U.S. Treasury yields have upward pressure on them. And more than that, bond market investors are nervous about U.S. inflation to the point where benign economic data doesn't move them to lower yields, but anything that looks inflationary to them, they're very sensitive to and they react to. So that means there's an upward bias in what's coming out, where if good news doesn't move the market down and bad news moves the market up, as far as
they're only watching for bad news, basically.
Right. There's higher sensitivity to bad news on the inflation front. That's putting an upward bias in U.S. Treasury yields. Government of Canada bond yields follow U.S. yields. We have so much trade with the U.S. that where they go, we follow. And ultimately, that'll affect our fixed mortgage rates.
Okay, so then why, if all this inflation looks like it's going to be happening, why is the Fed going to cut in September? What's with the cut? Because typically they try to get ahead of it. Why are we
Great
cutting?
question. So the Bank of Canada has one mandate. They have to maintain price stability. And if it was the BoC, they would have to be hiking in that environment. The U.S. Federal Reserve has a dual mandate. They have to maintain price stability, but they also have to promote maximum employment in the U.S. economy. The data revisions to U.S. employment that came out recently, just to recap, there'd been a bunch of banner results for U.S. employment, and it looked like the U.S. economy was chugging along. Then the last 2 months, the May and June reports were revised lower by 275,000 jobs, and all of a sudden the narrative that the U.S. economy could withstand the tariffs without much impact went completely away. And basically the U.S. employment market went from looking strong to looking weak. By the way, Trump fired the head of the Bureau of Labor Statistics in charge of the employment data and took a lot of heat for it. I mean, that's Banana Republic stuff. And by the way, those revisions, he thinks it's a conspiracy because any bad news that makes him look bad means someone's out to get him. But the revisions made total sense. If you're releasing data on August 1st about July, it's not going to be that reliable. You're going to have to do revisions later on. The initial number is always an estimate. And what happens is they call businesses and they say, did you hire anyone? Did you fire anyone? And ultimately, those businesses don't respond right away. The response rate now is much worse than it's been in a long time. And so what the BLS says is, well, we got to put out a number, and we're not getting the responses to have a reliable first take. So we're going to use plugs. We're going to look back 12, 24 months. We're going to look at the run rate, and we're going to average it out, and we're going to plug in a bunch of numbers so that we can put out a statistic. And then the following month, when businesses do respond, we'll update it. And then the second month after we release the initial estimate, we'll revise it one more time. And by the way, small businesses that are trying to run their businesses, they can't respond right away. Now, using those plugs to estimate the data works fine if the economy's chugging along as normal, right? If nothing's really changing, then past becomes prologue, and the best indication of the weather tomorrow is the weather today. But when you hit a turning point in the cycle, if you're using data plugs based on what's happened in the past, they're not going to be representative anymore, and you're going to have big revisions. So the revisions, there's no conspiracy. This is normal stuff. What it means is we're at a turning point in the cycle as far as U.S. economy goes, and that was the strongest confirmation. So the reason the Fed is talking about cutting is because it has a dual mandate, and the employment data are weak. So what they're saying is we are going to lean in against weaker employment, knowing that inflation is a concern because we have a dual mandate that allows us to do that. Now, is the pressure coming from Trump having an impact? Probably. Seems like there's a few Fed governors that are vying for the job, for Powell's job, and they want to say something that Trump likes hearing. Is it a good idea? I don't think so. I think it's a terrible idea, actually. I think ultimately Trump wants lower rates because the real estate market in the U.S., the regional markets need stimulus. They're not doing well right now. But if the Fed cuts rates and longer term bond yields go higher, the net result is restrictive for U.S. growth because the long end of the U.S. Treasury curve is where most of the borrowing happens.
They're not doing short-term rates. They're doing 15 and 30-year terms, right?
Even 5 and 10-year yields. I mean, the reality is if the yield curve steepens, then you got the rate cuts you wanted, but the bond market isn't buying it. Inflation's a problem. You're not listening to that problem. You're not paying attention to that problem. Bond market investors are going to say, if I'm worried that inflation isn't going to be kept in check and could move higher, I want more return, because if I'm going to make the same tomorrow as I'm making today on my U.S. Treasuries and inflation is going to be higher, I need a higher yield to compensate me for the erosion of my return that will happen when inflation moves higher. So big warning to the U.S. is be careful what you wish for, because it sounds like you're going to get cuts, but it may not turn out the way they hope.
Okay, so this is a great setup for my next question, which is, so what does that foretell for the Canadian variable rates and fixed rates are obviously getting pushed up because of this whole treasuries, but what is that going to do with variable rates? If variable rates in the U.S. go down, will the Bank of Canada follow suit? What are your expectations there?
Well, not necessarily. The Fed's policy rate is at 4.5, and the BoC's policy rate is at 2.75. So there's quite a gap. And just because the Fed cuts doesn't mean the Bank of Canada would automatically cut. The BoC is in a different scenario than the Fed. They've already done a lot of their cutting. The BoC's policy rate at 2.75 is right in the middle of its neutral range. So what that means is the policy rate, by the BoC's own estimate, isn't stimulating growth in the economy, but it also isn't restricting growth in the economy. When the BoC cranked its policy rate up to 5%, it was trying to cool inflation. It was raising the cost of borrowing. It was doing that to bring inflation back into line. Inflation settled back down. They've reduced their policy rate back to the neutral range. The question is, will they need to lower it to a stimulative level? And by the bank's own estimate, its neutral rate range bottoms out at about 2.25. So if the BoC wants to stimulate growth in the Canadian economy, its policy rate needs to be down around 2%. I think we'll get there. There's a lot of debate right now about whether we will. The economists at the major banks have quite a wide range of forecasts. Some of them think the bank's done. Some of them think more cuts are coming. The reality is, inflation right now in Canada is much more under control than it is in the U.S. And we don't have now. The caveat is, our CPI is at 1.7, but we canceled the carbon tax, and that means gas prices have automatically gone lower, which means that for the next 8 months, I think 8 or 9 months, you're going to get a nice tailwind from lower gas prices, because with the carbon tax taken out, that made them substantially lower. But there are some other things to pay attention to when it comes to Canadian inflation. Most of the upward pressure on Canadian inflation for some time now has been in shelter costs, and primarily mortgage interest rates, and also rents. And rents in real time right now, rents are falling in most of the country, certainly in the biggest markets. And mortgage rates are falling. And remember, they use an average and they look back with a lag. So, rates peaked and they've fallen. And that means there's going to be consistent downward pressure for some time now. The other thing is immigration has dropped substantially, and that was putting a lot of upward pressure on Canadian inflation. So if you're the Bank of Canada, you're supposed to look ahead, right? Their rate cuts only affect the economy. The full impact of a BoC rate cut takes at least 12 months. Some say 18 months. Some say as much as 24 months to exert its full impact on the economy. So they got to look ahead. They got to skate where the puck is going.
Right.
And if inflation is a little above target, but the primary cause of inflation is shelter prices, and those are consistently falling, and every indicator is they're going to continue falling, then does the bank look through that slightly? It's really core inflation that they're concerned about, because the CPI is below 2% now, below its target. But again, CPI is below target because of the elimination of the carbon tax. But the reality is, if you took shelter prices out, the CPI would be 1.3%. And last month, our key core inflation measures dropped a little. So all this is to say, I don't know if the bank will cut on September 17th, but I don't think inflation is going to prevent the bank from cutting again. And we're seeing a lot of weakness emerging in the Canadian economy. Our last employment report wasn't great. Consumer and business sentiment is not good. The GDP data doesn't look that great. Some of the lift we got of front running tariffs has now passed through the system. So if inflation isn't going to prevent the BoC from cutting if the economy needs help, and if all the indicators we're seeing are that the Canadian economy at some point is going to need help, and the BoC's policy rate has to be at 2% to be providing that help, and it's at 2.75% right now, then you add all that up and you say, I don't know if we're getting a rate cut on September 17th, but I think more cuts are coming. And I think ultimately we're going to land at 2. And by the way, over the last 5 rate cut cycles that the Bank of Canada has enacted, going back 25 years, their policy rate has always hit 2% or less. So if you think the BoC isn't going to keep cutting, you're betting that they won't follow a pattern that is well established. Last 5 rate cut cycles going back 25 years.
Okay, last 5 rate cycles. That's interesting stat. Okay, and then so all that to say, so if you're a borrower today, sounds like you and I were chatting before. You're kind of a mix right now of half purchase, half refi, which I think in the market you're in is good because seems like there's lower real estate transactions, but variable versus fixed. What does that conversation look like? So if I'm a borrower and I'm talking to you, what are your strategic options? Because I know you think strategically, and I know there's no one size fits all, but I like when you explain to me the different conversations you have depending on the client profile, essentially.
Sure. Well, first-time buyers, I think fixed rates really make a lot of sense. You're taking on the cost of a home ownership for the first time, and you want stability. Mortgage payments are, you're managing a lot. And ultimately, for first-time buyers, it's not about which option I think will save money. It's about what I think is if they're asking my advice, it's about what's best for them as they get used to being homeowners. If you're dealing with a renewer or somebody who's paid off a lot of their mortgage and it's a low loan to value, and it's really more of a rate question at that point. First of all, I always say my opinion in $2 will get you a hot cup of coffee. I follow this stuff closely, but anyone projecting certainty at any point shouldn't be trusted. And look, we don't know what Trump's going to do. He wakes up in the morning, and I'm not sure he knows what he's going to do an hour after he wakes up. So
maybe there's a magic 8 ball. He shakes it.
You know what? At this point, like
you're fired. It says I got to fire somebody today.
It doesn't make a lot of sense. Like The Economist had a great quote when he announced the tariffs on all the countries. They tried to figure out what his logic was, and they didn't basically say, they said, and I love this quote. They said the tariffs, the tariff rates are so random that it's almost like he set the tariff rates based on how many vowels each country had in its name. And, that's the world we live in. So there's a lot of uncertainty out there. If you said to me, all right, all that said, tell me what you think. I think variable rates are probably going to be cheaper over the long run. For most borrowers, they're going to be higher today as a starting point. So you got to take a higher rate today on the bet they're going to fall. I think fixed rates are cheap now relative to where they'll be over the next 3 to 6 months. I do think they have an upward bias. That is a contrarian point of view, by the way. I don't want to represent anyone else's opinion there. But I think fixed rates are probably going to go higher, and I think variable rates over time will go lower. It's all a matter of how much stability do you want? I mean, this is a very uncertain world. I think there's a lot of people out there who could go variable, who like knowing, well, I'm not locking in a fixed rate at the peak anymore. It's not like their rates are 6% and the Canadian economy can't withstand rates that high. We're basically back now at our 25-year averages for where fixed rates are. So in a world of a lot of uncertainty, if you like some stability and you want peace of mind and you can't put a price on that, I don't talk anyone out of their decision, but I think fixed rates for a lot of folks, for the peace of mind they give a loan, aren't a bad option. In terms of which I think will be cheaper, I think variable rates will be cheaper over the next 5 years. That is my assessment. But I don't think it'll be by a huge amount. I don't think we're talking a small compact car. I think we're talking a couple of nice dinners on the town.
Right. So it's a okay. And then so if you look at you probably don't have this data right in front of you, but your current pipeline, what is the mix of fixed versus variable you think in there? What are you seeing if you were to look at the?
Well, I don't have to look. I mean, I would say it's almost all fixed. We have the conversation. I do tell people I think variable rates will probably save a bit of money, but people want stability right now, and I think.
Right.
And the other thing is, people are relieved now with at least with fixed rates. You're not locking in at the peak anymore. Rates have come back down to their more normal levels, yeah, there are people that hope rates will go back to 2%, but I can, I remind them that it took a one in 100-year pandemic for them to get that low. The good news is you don't have to wear a mask anymore. The bad news is you're not getting pandemic era rate.
You're not getting money for basically free.
And quite frankly, I don't think that would be good for anybody. If that,
right.
Yeah, we'd get a short-term sugar high in our real estate markets, but prices need to come down. Affordability is stretched. We're paying a price now. Certainly, would-be home buyers are paying a price now for that excess, and we don't. A repeat of that would be bad. I think bad for Canada, bad for our economy, and bad for mortgage brokers in our industry. We shouldn't all be, well, we need lower rates all the time. To me, an informed person who's thinking responsibly about what's best for our country should be happy that rates are back to their 25-year averages, and if we're lucky, they'll stay there for a while.
So do you think there's a term that's the best value right now, or best, like, is there certain, with your clients that are taking fixed, is there a term selection that they like based on, or what's your thoughts there?
Yeah, so I mean, right now you can get a 3 to 5 for similar rates. It used to be for most of the time I've been a broker that if you wanted to lock in for longer, you paid a premium. So 5-year rates were higher than 3-year rates. During the pandemic, because we had spiking inflation, short-term rates were more expensive than longer-term rates. The cheapest rate you could get was a 5-year rate, but they were all lousy. And looking back, everybody was. You don't lock in a 5-year rate at 6% because the 3-year rate is 6.25.
Right.
Going shorter, and back then my advice was to go shorter and just get through it. And we refinanced a lot of those mortgages, or they've renewed. Today, 3-year fixed rates are a little bit cheaper than 5-year fixed rates, but they're still relatively similar. Long story short, if you can get a 5-year rate for the same rate you can get a 3-year rate for, I think the 5 years giving you 2 extra years at no additional cost. And again, with rates being back around their 25-year long-term averages, I think 5 years probably a bit better value. But I've got a mix of 3 and 5-year fixed rates. Those are the two most popular. And some lenders have promos on 3-year fixed rates that mean they're cheaper than 5-year fixed rates. And I think those are attractive too. So I would slightly favor the 5-year over the 3-year, but not by much. I think it really comes down to the lender and what the spread is between those two rates.
I want to know your thoughts on this. So if you were given the task of fixing the housing crisis, what do you think, or even consult the powers that be, what do you think is the solution, given all the data that you've ingested over the last 25 years about Canadian real estate, inflation, market? What do you think is the 2 or 3 things that would actually help? Because there's a lot of noise out there, but and this is your $2 opinion, your cup of coffee and your opinion, but I'm just curious what you think.
Wow. Off the top of my head, first thing I would do is get out of the market's way. Condos in Toronto were overbuilt. Right now, people are being allowed to close on condos using blanket appraisals that no longer reflect the current value of the property, and that is keeping values inflated. And to me, I think if the price of a new construction condo should drop by 30%, then it should drop by 30%. And there are, by allowing the purchase prices that were paid 2 or 3 years ago to be used to finance those condos. I understand if you're a bank and you've made a commercial loan to a builder, you want to make sure that loan doesn't go tilt. So you allow them to, you do a bunch of mortgages.
They're basically dispersing it from one one risk, which is the builder, to all of the homeowners, which is probably smart.
Well,
right,
from their perspective, they'd rather spread that risk out so it works for them. But the reality is those condos aren't worth as much, and that's not being reflected in prices to the extent that it should be. So I would get out of the market's way. And if that means there has to be a price correction, a material price correction, I would let it happen. Because if you're a first-time buyer who has been saving your money, waiting for prices to fall, it's not fair for you that they're not falling. You've done what you're supposed to do. The market was oversupplied. The speculators got greedy, and now should be your time. You should be getting a big discount on real estate, and that's how markets reset. It's a little bit like the forest fire. If you allow the fire to burn, then you have a bunch of, well, bad example right now, but in theory, if you allow the fire,
I know what you're saying. Forest fires have been a natural way to call forests and dead, and so that for regrowth, and they suck because we have a lot of things built in the ways of the in the path of these fires now. So it's not as simple as when the planet was was not that inhabited. But I understand it's the same thing. We got to let the market go through its cycles.
Right.
And it will more or less correct if we keep forcing it to one side too much. We're going to pay a price for this at some
eventually.
Point. There's nothing is free.
Eventually, the deadwood, you can prevent small forest fires, but the deadwood builds up, and eventually you get a fire you can't control, and it's much worse. So to me, I would get out of the market's way. Number two, there are some innovative things that people are looking at now that I think are pretty interesting. For example, if I was the government, I would be looking at projects where we allowed builders to build houses on land that was leased back to the government. So in other words, you're a homeowner. Today you have to buy the land and the house. What if you paid for the house on the land, and you owned the house, and you owned title to that house, and you could sell that house and trade it just like you could a regular house, but you paid a lease on the land that the house sits on, and that lease was owned by the government or owned by a giant private entity like a Brookfield. So basically, you rent the land and you own the house. In that scenario, what might cost you $1 million if you had to buy the land and the house might cost you $300,000. And there's a lot of public land that could be released for this purpose. And it would mean that the cost of housing would be accessible to a lot of people who can't afford housing today. And I'm concerned because if we don't let our young people buy houses, they're going to leave Canada. And our population is already declining. We needed high levels of immigration. It was poorly managed, but left to our own devices without high levels of immigration, we risk demographic crisis. So it's a problem we got to fix. I don't know, Scott. It's not like there's an obvious answer that people haven't thought of. I think I would say those two things: get out of the market's way, let prices fall, and number two, come up with innovative ways to make housing more affordable, like allowing people to buy houses on leased land, and the land is leased back to huge entities that it's like a bond. They get paid a rent.
They get a cash flow from it, and which maybe that's
interesting. And by the way, that land, you can't get a situation where someone says, "Well, I'm taking back my land, and now you got to get out of the house." Like land designated for that purpose can never be repurposed. It is for the purpose of putting houses on top that people lease, and the rates the rates used to lease that land are regulated rates, and basically you own a house and you pay rent for the land. And to me, there are lots of people with incomes who can afford to buy a house for instead of buying a house for $1 million, you buy the house for $300,000, and you pay $800 a month to lease the land. That opens up housing affordability to a whole lot of young people. And anyway, I hope they look at stuff like that.
I've never heard that before. I think the issue that I see is that the game doesn't feel winnable for young people anymore, right? And when it's not winnable, they don't want to play.
Scott, I have two 19-year-old twin boys. They're both talking about going to the States now. And neither of them likes the States, but they are aware that housing is too expensive. When they were 16 years old, They were talking about housing affordability and the fact that they don't see.
Well, that's because of you, dude. That is not a normal 16-year-old conversation, but that's got to be a household thing.
They're both doing business undergrad degrees. They should both be. They're from Toronto. They should be looking at coming to the biggest market and setting down roots here. Like the rest of the family. But in reality, if they can't own houses here, it's important to them. They want to go somewhere where they have to own houses. And if that's the U.S., then, we're going to keep talking about it. And I hope it doesn't come to that. But I think we should be concerned. It's a problem. It's a problem that needs fixing.
Right. Thank you, man. I always appreciate these conversations. Where do people find you online?
They can Google me, David Larock. They can go to my website, moreplan, morplan.ca. Thanks for having me, Scott. It's always a pleasure.
I love these. Yeah, I love these conversations. Thanks, man. Hey, thanks again for listening. Hopefully you got some ideas or inspiration, certainly, and insights from Dave. I know I always do. I always joke. I feel smarter when I talk to him, and then afterwards it starts to leak pretty quickly. So that's why we bring him back from time to time. But I'd encourage you to go find Dave's blog and get on his email list. It really does help simplify things for you if you're trying to understand how do I communicate this to my clients in a way that makes sense. And as Dave, he's a very humble guy, very smart as well. And I love these conversations. As I always say, there's no problem in your mortgage business that someone else hasn't already solved. Problem is who's got the answer. These podcasts are designed to provide some of those answers. Thanks for listening, and I will see you on the next episode.